You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Aston Martin, Novo-Nordisk, Airtel Africa, Rightmove, AB InBev, and our US company of the week is Disney. Sam, kick us off with Aston Martin.
Absolutely. We'll get probably the least investable company out of the way first.
Okay.
So Aston Martin, I'm sure it is a business that needs no introduction. They have come out with Q1 results and revenue fell 13% to 234 million. Despite a 1% increase in wholesale volumes to 950 vehicles, the revenue decline was driven by fewer deliveries of the special models, which carry a much higher average selling price. Underlying operating losses widened 13% to 65 million, reflecting the revenue decline. Free cash outflows reduced by 70 million to 120 million, and that was helped by selling down inventories and the non-repeat of payments related to the refinancing last year. Net debt rose from 1 to 1.3 billion. Full year guidance has been maintained, and they expect to deliver positive free cash flow in the second half and positive underlying operating profits over the full year. The way they're expecting to do that is through the launch of the Valhalla supercar later this year, which they think will drive a return to profitability. There's quite a few concerning things about this business, but worth mentioning, nearly 40% of sales come from the US. The 1.3 billion of net debt, they are paying double-digit interest rates on it. And the strategy revolves around selling more specials. However, if there's any issues or delays with that, that goes out the window. I would seriously question whether they're going to be cash flow positive anyway. Certainly with those interest payments, I could see a scenario where maybe they're able to manipulate the earnings in a way where they've got earnings, but I think cash is going to continue to flow out the door. And I think that's a huge, huge problem. In terms of valuation, there's no earnings, but the business trades at forward price to sales of 0.39. That compares to an average since listing in 2018 of 1.05. In terms of the share price, it's declined a ridiculous amount. It's now 81p a share. It's down 76% in the last 5 years. Down 41% in the last year, and it is a business that's got some serious problems. It's got a market cap of 800 million, but net debt of 1.3 billion. It is best known for 007, being that it's gone bust 7 times. However, I do think we're not going to have to wait that long before it is 008. So, John, do you have anything positive to say about Aston Martin?
I suppose you can argue it's an iconic brand, but as you say, it does have that history that goes with it in the sense that it's gone under 7 times. Some positive things, I suppose, that the US trade deal that's been announced, that's a lifeline for the company. But otherwise, I do agree with you. I think it's uninvestable.
They're reckoning that they're going to be cash flow positive, I think is extremely optimistic. And I think they are kind of inclined to present the most optimistic view because it affects the rates they're getting on the debt that they are being forced to take out. But if you look at the track record, they have not delivered previously. John, should we move on to a business that, is very investable?
Absolutely. It's one that we both own shares in now. It's Novo-Nordisk. It's the diabetes-focused pharmaceutical company based in Denmark, and it owns various insulins, but it's come to prominence more in the last couple of years with Ozempic and Wegovy. Anyway, Novo-Nordisk had their Q1 results out, with the group growing first quarter sales by 18% to 71.1 billion Danish kroner when ignoring currency movements. Obesity care was particularly strong, rising by 65%, led by growth in international markets. Operating profit rose broadly in line with sales, up 20% to 38.8 billion Danish kroner, and free cash flow improved to 4.5 billion Danish kroner, and free cash flow improved by 4.5 billion Danish kroner to 9.5 billion. Better operating cash generation more than offset increased capital expenditure, and net debt was flat at 77 billion kroner. A final dividend of 7.9 kroner per share was announced back in March, increasing the annualised payout by 21% to 11.4 kroner. For 2025, sales growth is now expected to be between 13 and 21%, and operating profit growth is now to be at constant exchange rates down from respective ranges of 16 to 24 and 19 to 27%. And the shares were up around 6% in early trading. In terms of valuation, Novo has a market cap of £164 billion and trades at 15.5 times forward earnings, compared with a 10-year average of 24.2. It has a prospective dividend yield of 3.2%. I thought this was a really good set of results. I think what I've begun to appreciate more about Novo, in terms of the more research we've done about it, is it's quite a diversified business within the diabetes sector. It's been around for a long time, and it does have a really strong traditional insulin business with brands like Tresiba, Levemir, Nova Rapid, Nova Mix, and it does extend also into a little bit of HRT as well. But the big news with it, and it has been for the last couple of years, is the GLP-1s, so Ozempic and Wegovy, and particularly what they're able to do in the obesity market and with weight loss. It does have an oral semaglutide, but it's researching further into whether there's going to be another big Wegovy equivalent for weight loss as an oral tablet. And I think that's going to be the next big thing. But you're seeing this huge rise in the revenue driven by the sales of the GLP-1s. It does seem to have a lot of expertise in that, and it has about 2/3 of the US market. I think there are very high barriers to entry when it comes to that, even though there are some non-branded products coming through, which I think, Sam, you may come on to in a moment. That being said, I think together with Eli Lilly, it does seem to have most of the market tied up. And I think as you're seeing more and more studies coming out and more uses for the GLP-1s, I think the sales are only going to continue to increase. That being said, if you look at the share price and the valuation of Novo-Nordisk, I think it's come back down to earth a bit compared with its highs of sort of 2022, 2023. And it looks much more reasonably valued at 15.5 times forward earnings. So for me, I think that's looking like pretty fair value for it. And it even at the current value has a dividend yield of 3.2%, which I think is decent too. So I'm a very happy shareholder, and hopefully we can continue like this going forward.
I would agree. There's not really anything to complain about in those results. It's a bit, I don't want to say disappointing, because I wasn't particularly disappointed, because I think we're very recent shareholders. We've both bought within like the past month, and it's just been so badly beaten up that if you were to see the share price performance for the past 12 months and then go through the results, you wouldn't think they were the same business. And I think expectations were so low going into these results that actually the only slight negative was the downgrade in the guidance, but I think the expectations were worse, really. And even the slowdown in the guidance, if it wasn't for the unregulated alternatives that are basically being marketed without like FDA approval in the US, I don't think that guidance wouldn't have been lowered. So in terms on the company side, it's doing everything it can. And, you look at that future pipeline where you've got the oral application, but last time we covered the business, there's a lot of other potential applications for some of this stuff. And you've got the excellent insulin business that is basically the foundation that it's built on. And it just feels to me like it's priced as if, even if the GLP-1s fail, it's still a pretty average. I think it's a pretty reasonable multiple for most pharmaceutical businesses. So even if it were to fail, which I think is very, very unlikely at this point, but it's kind of priced as if the GLP-1s aren't there. It's priced as it was before they started taking off. I just find it slightly bizarre. I think the market's gone from kind of maybe overestimating how wonderful everything's going to be, and it's just, Mr. Market's gone the other way. And I say unfortunately, it works quite well for us because we were never going to buy it at like 40 times earnings or whatever it was. But 15, it's low enough that I feel comfortable with the stuff I don't know, because it's kind of a bonus anyway, the stuff I struggle to understand. But yeah, very, very happy as a shareholder. I think in terms of the first set of earnings after buying, I don't think there's anything else I would reasonably have expected.
Yeah, no, absolutely. So very good. Let's move
on to another business that we're both shareholders in. I think we might have 4 businesses today that we're both shareholders in.
I think you're right, yeah.
That must be a high.
Yeah.
Makes the pick of the week more interesting.
Yeah, absolutely, it does. Airtel Africa then, Sam.
Airtel Africa, the second business of the week that we both own shares in. So, for anyone who's not familiar, which is probably the newer listeners, because we have been covering this company for a while, but anyone who's not familiar, Airtel Africa, it's an African telecoms business. They operate in 14 African countries. So they provide mobile services, and then they've also got a segment of the business called Airtel Money, which you can kind of think of as like a cross between the PayPal of Africa, but also like more of a traditional bank as well. So Airtel Africa, they have come out with their full year results, and the total customer base grew by 8.7% to 166.1 million, with the focus on digital inclusion supporting a 4.3% increase in smartphone penetration to 44.8%, which is worth noting is still pretty low compared to what we're used to over here. Data customers increased by 14.1% to 73.4 million, with data usage per customer increasing by 30.4% to 7 gig, supporting average revenue per user growth of 15.4% in constant currency. Continued investment in the Airtel Money Agent Network, enhanced digital offerings and expanded use cases contributed to a 17.3% increase in mobile money subscribers to 44.6 million and an 11.4% growth in constant currency average revenue per user. In Q4 2025, transaction value increased by 34% in constant currency with annualized transaction value of $145 billion. And all these figures are reported in dollars, by the way. The strategic focus on great customer experience was underpinned by sustained network investment with the rollout of 2,583 new sites and approximately 3,300 kilometers of fiber, supporting increased data capacity across the region. The revenue grew by 21.1% in constant currency to 4.95 billion, but declined 0.5% in reported currency as currency devaluation impacted reported revenues. We'll get to this at the end, but I'm actually, as a shareholder, pretty pleased with that because we've seen a few of these devaluations. It was worse in the last set of results, but the business has grown by enough to offset it, which I think, given how bad some of these Nigerian devaluations were, is all that you could have asked for. Strong execution and the tariff adjustments in Nigeria contributed to a fourth quarter of accelerating growth, with Q4 25 revenue growth of 23.2% in constant currency and 17.8% reported currency as currency headwinds eased. Across the group, mobile services revenue grew by 19.6% in constant currency, driven by voice revenue growth of 10.6% and data revenue growth of 30.5%. Mobile money revenue grew by 29.9% in constant currency. For the year, underlying EBITDA declined by 5.1% in reported currency to 2.3 billion, with the underlying EBITDA margin of 46.5% compared to 48.8% in the prior year, impacted by increased fuel prices and the lower contribution of Nigeria to the group. However, following a more stable operating environment and benefits from the cost efficiency program, underlying EBITDA margins have expanded from 45.3% in Q1 25 to 47.3% in Q4. Profit after tax of 328 million improved from an 89 million loss in the prior period. Prior period was significantly impacted by the derivative and foreign exchange losses, primarily in Nigeria. Basic earnings per share of 6 cents compares to negative 4.4 cents in the prior period, predominantly reflecting lower derivative and foreign exchange losses in the current period. Earnings per share before exceptional items declined from 10.1 cents to 8.2 cents, largely due to higher finance costs arising on the account of tower contract renewals, which had a neutral to positive impact on cash flows and a deferred impact on prior period currency devaluation. CapEx of 670 million was below guidance, primarily reflecting a deferral of data center investment. CapEx guidance for next year is between 725 and 750 million. They've been consistently reducing foreign currency debt exposure, having paid down 702 million of foreign currency debt year over year. Furthermore, 93% of the operating company debt, excluding lease liabilities, is now in local currency, up from 83% a year ago. I think this is very, very positive because, as we've seen with Nigeria, these currencies do have the potential to devalue a lot. And if your debt is all in dollars, for example, you're in a much worse position. Whereas if it's in the local currency, you are much more protected from that. Leverage has increased from 1.4 to 2.3x, primarily reflecting the 1.3 billion increase in lease liabilities arising from tower contract renewals. Lease-adjusted leverage increased from 0.7x in the prior period to 1x, reflecting the impact of lower lease-adjusted underlying EBITDA, given the translation impact arising from currency devaluation. The board has recommended a final dividend of 3.9 cents per share, taking the total to 6.5 cents for the year, which is up 9.2%. And in addition, they returned 120 million through share buyback programs. They've also said they're making significant progress in the preparations for the Airtel Money IPO and remain committed to this objective. However, they are mindful of evolving market conditions. Therefore, subject to these conditions, they anticipate a listing event in the first half of the 2026 calendar year. So in the first half of next year, at some point, Airtel Money is going to be spun out as its own business. So with that in mind, we will go over it in a bit more detail. So they've said in the Airtel Money section, we accelerated digital adoption by deepening the functionality of the Airtel Money app and promoting self-recharge. The result is an accelerating adoption and greater penetration. In 24-25, the transaction values on the My Airtel app reached 4.7 billion, a 91% growth year on year. Monthly users have grown by 2.1 million, while penetration across smartphone customers has increased to 21 from 14% since 23-24. These gains supported higher customer activity and improved unit economics across key markets. Our ecosystem expanded significantly. We introduced new use cases, including loans, savings, and card-linked products, while adding new international money transfer corridors and onboarding new partners. This widened the relevance of Airtel Money for both retail and business customers. Access was strengthened through targeted investment in our physical footprint. Airtel Money kiosks and mini shops increased by approximately 1,000. The key enabler was our digital agent onboarding process, which helped scale the non-exclusive agent base by 23%. These efforts supported a 17.3% increase in our customer base, reaching 44.6 million users and representing 26.8% of the total customers. Mobile money continues to be a key growth engine for the group. Annual transaction value reached 145 billion, and I think that was about 53 billion when we started covering it a few years ago. I've got a figure in my head of around 50 billion, so I think it's tripled in the time we've been following it. While Airtel Money revenues grew by 30%, contributing 20% plus to overall group revenues, we remain focused on building Africa's most accessible and inclusive digital financial services platform. And if you look at Airtel Money as its own business, so customer base up 17.3% to 44.6 million. Transaction value was up 32% in constant currency and 21.5% in reported currency to 136.5 billion. And the average revenue per user was up 11% to $2. As its own business, it would have revenue of 994 million, and the operating profit on that would be 489 million. So you are at almost a 50% operating profit margin, which is radically different to the rest of the business. When you look at Airtel Africa as a whole, the share price has done very well recently. However, the market cap's still under 6 billion. Currently trades at a P ratio of 34. However, that's on the reduced earnings. If you look at it, a forward PE, it's more like 22. It's actually 5.6x free cash flow. The free cash flow is distorted though, because they did do lower capex in the year. But the point is, on a PE basis, it's high, but when you actually look at it, it's pretty cheap in terms of the cash it's generating. I think what's interesting though is 6 billion for the lot, including the legacy business, which we're both pretty positive on. And they've done a good job within the time we've followed it. But Airtel Money, it's growing 30% a year locally, 19% in constant currency, and it's got nearly 50% operating margin. And the revenue's just under $1 billion. So it's probably got, although the transaction value is 136 billion, but you look at that and you do wonder how big that could get, and also what kind of multiple it would trade at on its own. And how much would you pay for that operating profit of 489 million? I just think, I think the value of it is being dragged down by the legacy business. I do actually think this delisting is probably going to, I'd be surprised if the combined value of the two separate entities weren't higher than the current market cap of 6 billion. John, as a shareholder, what do you think of the results and also Airtel Money in terms of the valuation?
I mean, I think the group has had a very difficult time with the devaluation of currency in Nigeria. That being said, it's coped very well. I do agree that if they were split, I think you're going to end up with a bigger total valuation. And I think for me, both sides of the business are attractive, but it's the money side where you're getting that huge growth. And I think the traditional telecoms business, it's not like a Vodafone in Europe where it is very saturated. It's still in an emerging market and growing well in its own respect. But I think that money side of it is really exciting as potentially as a separate prospect. I'd be interested to see what they try and list it for. I guess it's still a way away. There are lots of uncertainties in the market more generally, so very difficult to predict. But I'm certainly very happy as a shareholder, and if it is spun off in the first half of next year, I probably will just retain shares in both.
Yeah, so we did discuss this, I can't remember when, but recently off air. But I think my plan is also to retain shares in both, just because, well, firstly, I like both businesses, but there's a lot of unknowns really, because you don't know the valuations that they're both going to trade at separately. You don't know how much of the debt they're going to try and pawn off onto Airtel Money, because the thing is, Airtel Money is probably going to be able to repay a good amount of debt because it's going to generate so much cash. So they might try and get rid of some of the debt. We've seen it before with businesses when they've done that. They do tend to give the spin-off more debt than maybe it has actually taken, if that makes sense. But yeah, I think both businesses, unless one of them's just at a ridiculous valuation, my plan would be to keep both and just kind of let them perform on their own and see how they do. Because in terms of the combined entity, I'm happy with the performance of both parts of the business.
Yeah, no, absolutely. Me too. Okay, on to another one we own then.
Absolutely. How are Rightmove doing?
Well, they had their AGM and had a trading statement out for the 4 months ending 30th of April. In terms of the full year guidance, it remains unchanged at between 8 and 10% revenue growth. In terms of their average revenue per advertiser, that's still growing, with membership having increased with expected 1% growth in 2025. Underlying operating profit margin is expected to remain strong at 70%. And the group also comment that they've had over 2 million instant online valuations that have been run by their service. They're trialing AI keywords for personalized searches, and there's a new homes package called Ascend, which was introduced with a live booking and lead enhancements. Home views reviews has been added for the build to rent listings, and they've launched a commercial API in April. In terms of broader market conditions, they say that the resale market, there were positive indicators year on year, increased in buyer demand by 5%, listings by 9%, and sales agreed by 7%, and listings are currently at a 10-year high. In terms of the rental market, demand easing, but still above pre-COVID levels, and the rent growth slowing. Developer sentiment improving with supportive economic factors, and mortgage rates falling, which gives an overall more favourable outlook. And the chief executive had commented on the strong momentum and resilience due to Rightmove's UK focus, subscription model, and business-to-business orientation, and confirms confidence in the full-year performance despite broader global uncertainties. In terms of Rightmove's valuation, Rightmove has a market cap of £5.6 billion and trades at just under 26 times forward earnings, which is just below its 10-year average, and it has a prospective dividend yield of 1.3%. I don't think there was a huge amount in this statement, essentially reiterating what we already knew, but certainly positive that is expected to continue, and with those very solid operating profit margins. I think one of the concerns had been the competitor, Homes.com, from the States moving in and acquiring on the market. That certainly so far doesn't seem to have had any major impacts on Rightmove, which is very reassuring. And they seem to be maintaining good near monopoly market share, and with those results accordingly. So I think that's something that I'm certainly more reassured about. I know we discussed it a year or so ago when that news came through, but it's still looking very solid. So what are your thoughts on this trading statement?
Pretty similar. I'm not entirely sure we needed a statement as shareholders to know that revenue was going to go up 8 to 10%, because it does just do that like clockwork generally.
That's true.
It's nice to have it confirmed. I think what I really, really like about it is, well, obviously it's hard not to like a business with a 70% operating profit margin, but it's got, like you say, a near monopoly. The amount of views on the page when we cover the actual results, the amount of like viewer time and page views is just ridiculous on it. It is a monopoly in the UK, and they've still got the ability to increase prices, which they are doing. But because of those high operating profits, so much of that price increase just flows straight through to the shareholders. And you can see it in terms of, in the time we've owned it, it's not really, the growth hasn't blown the lights out. It's just been sort of the solid, probably 8 to 10% a year that we've just seen in that statement. But despite that, so if we ignore 2020, which was the COVID year when they voluntarily dropped prices to help the agents out, that was an anomaly. So if you take 2021, which was the first year post-COVID, the earnings for that year were 21p a share. For 2025, they're projected to be 29p a share. So it just does show you the power of those revenue increases in terms of the way they're flowing through. Because, so the earnings have gone up 38% in that period, which for a business that already had a monopoly, I think is really, really impressive. And it trades at a forward P of 25, which I think, given the quality of the business, if it were lower than that, I'd probably be topping it up. I don't think I'll be adding at 25, but I'm certainly not selling. What about you, John?
I'm happy holding.
Right. What do we have next? Oh, we don't own this one. AB InBev. Perhaps this will change your mind though, John.
We'll see.
If your comments on Heineken a few weeks ago were anything to go by, I hope so.
Yeah.
So AB InBev, they are the brewer. They're pretty much just lager, really. So when you look at the brands, the main ones you'll recognise are Budweiser, Corona, and Stella. So they have come out with Q1 results, and revenue was $13.6 billion, and all the figures are reported in dollars, which was up 1.5% on an organic basis. Growth was driven by a 3.7% price hike and better product mix, offsetting a 2.2% decline in volumes. Underlying cash profit grew 7.9% to $4.9 billion. And that's higher than the 3% that was expected, and that was supported by higher sales and prices as well as lower costs. Full-year cash profit guidance has been reiterated, and they expect that to grow by 4 to 8% in line with the medium-term target. The shares rose 2.9% following the announcement, and volumes declined in the US. They blamed the US decline on poor weather and the less favourable timings of Easter this year, but they did highlight that they managed to gain market share. And in terms of tariffs, 98% of volumes are produced locally, so they should be pretty much unaffected, except for that 2%. And net debt is currently 2.9 times cash profits, which is above the target of 2 times, but I don't think it's a level where it's hugely concerning, although it's higher than you'd like. Business trades at a forward P of 17.3, and that compares to a 10-year average of 19.4. The prospective dividend yield is 1.9%, and that compares to a 10-year average of 2.6%. I think my comment's very, very similar to Heineken. I think the volumes drop is concerning. I think there's a trend to premiumization. I think they would argue that some of the brands like Stella, for example, are more premium brands, but I'm not sure this premiumization trend necessarily applies to their brands. I think if you were going to premiumize, you would pay a bit more for an IPA if you were like a lager drinker or something, or you would just move to something like spirits. I think the argument of premiumization works a lot better for Diageo than it does for AB InBev or Heineken. I think the volume drop is concerning, and when I look at their brands, I would expect that to continue unless Gen Z start drinking a lot more than they are currently doing. I think this is a start of a longer-term trend, as with Heineken. And I actually think if you compare it to Heineken, which trades at roughly the same price, I much prefer Heineken as a business, just just because, I mean, I definitely prefer Diageo of the three, but between AB InBev and Heineken, I prefer Heineken because when you look at the brands, at least it's got like the ciders and stuff in there as well. So I feel like it's slightly more diversified, but still has a very similar problem. So yeah, I just wouldn't touch it. And I think at 17 times earnings, I don't even think it's hugely attractive anyway. John, what do you think?
Yeah, no, similarly, I think the generational shift to drinking less is a major problem for them. So, and you are seeing volumes going down, and the way that, I suppose, the example that you give, Diageo has been combating that is to have more of a premiums, the premium spirits, premium prices, as you say, works a lot less well for lagers compared with spirits, and therefore, how do you combat it? And that's the question that I don't think they've been able to answer, and it's not I don't think it's reflected enough in the price. So I wouldn't be buying the business, certainly.
Do you have a preference between, if you had to have one, AB InBev or Heineken, do you have a preference?
Probably not. Probably not. I don't know whether I'd lean slightly towards Heineken, but I'm not sure really.
Well, they've got the same problem anyway, I guess.
Yeah, it's difficult, really, I think, to differentiate them too much. And I think the brands are both, perhaps they're slightly more diversified at Heineken, but yeah, it's.
But again, you look at Heineken, and although I think they've got a slight more diversification because of the cider, there's still not really anything I'd regard as premium.
Yeah, and it's the same problem with cider, really.
Yeah, it is. Yeah.
So.
Yeah. So, should we move on to the final business that we both own this week?
Yes, no, absolutely. So we'll move on to Disney. We haven't covered Disney for a while now, but they had their second quarter results out, with the group reporting second quarter revenue of $23.6 billion, which was up 7% ahead of the 5% expected. In entertainment division, double-digit declines in linear networks was more than offset by growth in the streaming brands, which includes Disney Plus and Hulu. Experiences, which includes the theme parks and cruises, saw sales rise 6%. Segment operating income rose 15% to $4.4 billion, helped with the revenue growth and lower than expected costs. Free cash flow rose by $2.3 billion to $5.6 billion over the first half, and net debt stood at $37 billion. In the third quarter, the group expects a modest increase in Disney Plus subscribers. Full-year underlying EPS growth guidance has been upgraded from high single digits to over 16%. The group completed a $1 billion tranche of share buybacks in the period, and the shares were up 6.1% in early trading. In terms of valuation, Disney has a market cap of $190 billion and trades at 16 times forward earnings, compared with a 10-year average of 23.4, and it has a prospective dividend yield of 1.1%. I thought these results were really good. I think they're the best results we've seen in a very long time with Disney, possibly the best results since I've owned the stock. I think you'd had, when Disney Plus was first launched, there were some impressive numbers there, but I think since then they have struggled a bit. But this was I thought, really, really good set of results. I think the other thing is that we're seeing now with Disney Plus, they're really increasing the prices. Initially, it was just user growth, and I think everyone would agree they had much better user growth than they could have expected within the first probably year of launching. It was very affordable. It's certainly less affordable now, but they don't seem to be seeing the numbers drop off as they're turning up the price. And equally, when you're looking at the parks business, or the experiences business, I should say, that's performing well too. So I think overall, it's looking like Bob Iger's done a great job since he's got back. I think at 15 times forward earnings for a business of the quality of Disney, it's very reasonable too. So I'm certainly a very happy shareholder, and probably happier than I've been for a long time of holding Disney. Sam, what are your thoughts?
Very similar. I think it's interesting as well, because in the Disney Plus, I think we'd kind of gotten used to seeing it making a much more positive contribution to the business, but that was at the expense of subscribers. But the subscribers are actually up 8.4% compared to where they were 12 months ago. So as well as raising the prices, the subscribers have started growing again. And you could argue those subscribers are actually of a higher quality now, because they're paying more. And a lot of the ones they lost, they were really like not making any money on them at all. So I think at a full, like you say, that forward PE, I think is very, very reasonable. Only thing I don't like, I'd rather see them paying down debt than buying back shares, but the debt's not a hugely concerning level. I think as well, last time we covered it, because it was cheaper, so it's now, I mean, it's still pretty reasonable, I think. So $106 a share now, and it has been lower, and it was the last time we covered it. Did we discuss it maybe as part of like the Orange Swan? Because I was basically saying last time that although it was cheap and I would consider adding, I felt like because the results had been disappointing for a while, I didn't want to add because it was effectively in the naughty pile, where I felt like the business, it was getting to the point where I'd owned it for a few years and it just been quite disappointing. Whereas now I feel like it's a business I could add to. And yes, I'm not adding it as lower price as if I'd done it a month ago, but I think it's, the results are there for the first time. I still think as well, in terms of the quality of the IP, I think Bob Iger still has a way to go in terms of unlocking some of the value of that. I think some of the content that has been coming out recently, and especially on Disney Plus, I actually think there's still a way to go. I think there's still a lot of potential to increase those earnings. I think Disney Plus can, I think some of the content on it's actually pretty average. So to be putting up those results is excellent, but I think it can do even better. So for me, it's actually a business that I might add to before the next time we cover it. What about you, John?
I don't think I'll be adding, but I'm very happy with what I'm holding. I have topped up on it a couple of times, so I'm happy it's sitting. And if it performs like this, maybe I will consider it going forward. But I'm quite happy with what I've got in there at the moment.
In that case, of the 6 businesses we've covered this week, Aston Martin, Novo-Nordisk, Airtel Africa, Rightmove, AB InBev, and Disney, which do you like the most and which do you like the least?
Oh, it's a very difficult one. I'd probably say I like Novo the most, and it's an easy. I think Aston Martin's uninvestable.
Yeah, so Aston Martin picks itself as the lowest. I think, fortunately, even if you were to strip Aston Martin out, I think AB InBev then picks itself for me, which is quite nice because it actually leaves the 4 companies that we own, which is where you'd want it to be. But I think best one for me, I think I'd have to go with Airtel Africa. I think it's those Airtel Money results for me. I think I could see that being a business that trades at a much higher valuation in terms of the multiple than the current business does. And, it just feels really, really cheap when you look at what you're getting. And, I just think if Airtel Money was a separate business, what would people pay in terms of the earnings? And I think it would be a lot higher. So I think that's very, very exciting because it's kind of 12 months away. And despite the way the business has performed, because it has done really, really well recently in terms of the share price, I still don't feel like it's fully factored into that share price.
Yeah, no, fair point. Okay, well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.